Hello and welcome into the KE Report. Shad and Corey here as your host, and today we're getting an update from our friend and colleague Jordan Roy-Byrne. Jordan is the publisher of The Daily Gold, and we will put a link to that down below so you can follow along with Jordan's work. He's also the author of the book Gold and Silver: The Greatest Bull Market Has Begun. I think it's pretty obvious that we have begun the greatest bull market in gold. It's off to a big start here as far as the momentum that's been building across the sector really for a couple of years now, where the producers and gold have been running. Then you see it trickle down into the mid tiers. Then you've seen the developers start to get the process of re-rating going, and even some of the drill plays are getting action. We've seen a lot of stocks up 100%, 200%, even 300% just over the last year or so. And a lot of that happened this year. The GDX, GDXJ, SIL, SILJ, all up over 100% this year. So, Jordan, I just got to ask you, coming out of the gates here, when you've seen this kind of momentum in the sector, and we look at what the prime mover is, it was gold that started it all. Gold is now up, it hit 3,800 earlier this week, but it's up at near all-time highs. How much room left is there in this move from gold, and how does that trickle down to the rest of the sector?
There could be a little bit more room left in the short term. But when you're coming into these short-term peaks, things can get a little tricky in precious metals because depending on whether it's a short-term intermediate or more of a significant peak, you've had different performance out of the various indices where, one thing is top before, one thing has top later. Certain stocks have been leading. The stocks were acting weak heading into the top. So, yeah, those things aside, I think this move has really been driven for me by the breakout in gold and the previous breakout in silver. So I think the metals are driving the last bit of this move that started with the cup and handle breakout about 18 months ago. So looking at gold, I have measured upside targets based on the breakout at the end of August or the beginning of September of 3750, 3900, and 3950. So the way I've measured the breakout, if you look at daily closing prices and if you look at the candles, it looks like a breakout from a bull flag, even though it consolidated a tad too long to be a bull flag. It looks more like a bull flag breakout than a triangle breakout. And so based on that, you would take the move in April where you went from I think 2970 up to 3420 or 3430 if you're using closing prices. And then you would project that onto the breakout point, which was, yeah, at the very end of August here in the low 3400. So I think that's how you get to 3900 or 3950. So there's still a little bit room, or I should say more than a little bit for gold to move, because today it's down 3763 in futures and a little bit lower in spot. So there still would need to be some more buying to come in for gold to get to those targets. And looking at silver, silver has come up to this area, which is the last significant resistance on the way to 50. So that's one scenario. It's always important to look at scenarios when just the odds are kind of mixed, and or I should say the probability is kind of mixed. But yes, the short-term bullish scenario would be gold continues up to those targets, 3,900, 3,950, and silver continues. It's able to push up after the selling and get to 49 or 50. So I think in the short term, those are the targets for gold and silver. And then at that point, I think we're setting up for an intermediate term peak. Before, a couple weeks ago or a month ago, I was looking for kind of more of a medium term peak. But at this point, if you look at the new highs in GDX and GDXJ, just completely blown out to the upside. In fact, if you look at a 20-day moving average of the new highs in GDX, it's really probably the biggest in history, in modern history for the gold stocks. Now, that's a really good thing in general. It means we're in a really strong bull market. But when you get to that point and you're 18 months into a move, that tells you you're going to stop and rest at some point. And not to babble on here, but one thing I would add is if we're not going into a recession, you're probably going to see capital move into the other commodities and less so gold and less so silver. If you need a reason, that could possibly be a reason where gold and silver slow down here because, well, the Fed cut, but maybe if the economy perks up, then they're not going to cut anymore after that. So I think that's one, just a narrative, that's the word. That's one narrative that perhaps we could see that could slow down gold and silver going into next year after they get to those targets I mentioned.
Jordan, I find this also interesting that so many people in this sector are talking about what the top looks like or a correction that's due during this bull market. No one's calling for an end to the bull market, especially for precious metals, gold and silver and the underlying equities. But we've been hearing so much about maybe you should trim over the last couple months, and the sector has kept moving higher. Even that sideways consolidation of gold over summer, if you stayed with your gold position, yeah, you missed opportunities in maybe some other areas, especially in the juniors, but you didn't really lose money. And sometimes I feel like you can almost overplay your hand in these bull markets because they can go longer than people expect. And that's just the definition of a bull market. So, why should we be trying to get ahead of some sort of correction rather than wait for a more solid sign that a correction is just starting? Maybe give up 5% of whatever your position is rather than potentially missing 10, 20% on the upside by trading out of it too early.
Well, there's a lot to say about that, and I'll try and do it as coherently as possible. But number one, you're absolutely right. And that's something I've learned the hard way. My trade is technicals. And in past years, even though we weren't in a secular bull market, I was losing money by trying to trade or we're going to hedge right here. And that's just extremely difficult to do. Like there's about five people in the world who can do that. And that's why they're, managing multi-billions. And that's my motto for the bull market is buy, hold, and trim. And so the reality in the last month or so, we've been in a hold or trim. That's really the question. But what you said there is so important, Corey. That's how you are going to make money over the long haul. It's buying the right companies and holding. And so people need to pay more attention. I mean, they honestly need to pay a little bit less attention to technicals, way less attention to all these people talking about macro and trying to predict the economy, and then fivefold more attention into picking the right companies. Because if you pick the right stocks in a bull market, even if you don't have the best entry point, you're going to do really, really well. Like, doesn't matter if a stock goes to 20, doesn't matter if you bought it at 225 or 280. I mean, not really. So that's what people need to focus on and not trade in and out. You're exactly right. But there are some rules you can follow to tell you when you should trim. And, with respect to where the sector is, that is one. And so we could be coming into an intermediate term peak here. Again, I don't know if it's going to be tomorrow or if it was yesterday or if it's going to be a month or two from now, but very big picture, we are likely to make an intermediate term peak. So we are going to see some softness going into next year. And whether to trim or not, there's so many examples. I mean, yes, the sector trend is one, but more importantly, if you have a diversified portfolio in the stock, it becomes way too large. You need to trim that and reduce your risk. Secondly, it's also company specific. Well, let me go back for a second. The third thing is company specific. Second thing, does the chart look like a rhino horn? If you're looking at a 4 or 5 year, 3 year chart, whatever, a long-term chart. I don't care if it looks like a rhino horn on a 6 month chart, but if you're looking at a longer term chart, 3, 4, 5 years, and you have a rhino horn there where it's gone straight up, you need to trim that. Third thing is company specific. It's one thing if you own a real high quality junior company that you're looking out a couple of years and you can see, yeah, they're going to add tons of value, whether gold's at 4,000 or 3,200 or whatever. That's something you can hesitate to trim versus, you own some hot exploration company. It drilled a couple of really good holes. They did some promo. The thing got pumped up. The chart looks like a bit of a rhino horn. I mean, something like that in most cases, you need to be more aggressive about trimming. So company specific in the fundamentals. You have to look and assess these companies company by company. And I know that's difficult for a lot of people to do, but when you're assessing these companies against each other, you can see, like I did an update looking at 20 silver stocks I didn't own last weekend for subscribers. And I was looking at all these stocks I don't own. I came away, there was one that I was really impressed with. And I looked at it and I just thought, this is the value here even though the stock has gone up a lot, the value here is way better than these other stocks. So if I owned, all these stocks, okay, there's one here that I would hold versus I'm going to trim these other ones. So you have to compare the stocks you own against each other. And finally, yeah, it's so important to know how to evaluate value. and what the real value is of these companies. Because if we're coming into an intermediate term correction and you see GDX and GDXJ, I mean, they could decline 25%. And so a lot of these juniors that have gone straight up, I mean, the lower quality ones, they could go down 40 or 50%. They could go down 20 or 25% in a week or two. So those are the stocks that you need to be trimming if they have the rhino horn chart, if you have huge gains, if they're too much of your portfolio, versus other stocks that have a much stronger value proposition over the next year or two.
Yeah, so many great points there, Jordan. I hope people go back and re-listen to that. A lot of great points on where to trim. And if there is an intermediate correction, like you say, if the GDX or GDXJ was to go down 20%, a lot of juniors could double that and they could go down 40%. So, of course, you'd want to trim some and get out of the way of that move. Why sit in there and hope for better days? But if you talk to companies, we were just at Beaver Creek and had all these meetings, Jordan, and every single company tells you they have a catalyst. Every single company will tell you to your face or to anybody that listens that they've got all these news things coming that are going to propel the company forward. But the reality is a lot of their news is not going to impress. Some of it may become a selling event. So when you're looking at the value, when you say that's an important part, what really sticks out to you is the things that you think, hey, this actually is going to be value accretive, that actually could move the company up, even in a tough or sideways market. What are the criteria that you really zero in on, Jordan?
Well, explorers, developers, and producers, they all have different criteria. I mean, one thing with respect to the developers and producers, and those are easier to value, because they have economic studies or they have cash flow right now. I mean, you look at what are they trading against NAV or the net present value of the project? Like, what are they trading? You're looking at that valuation, and then also you're applying like not really low metals prices, but 3,500 gold or 3,300 gold, or for silver, $35 silver, for example. So you're evaluating these things at present metals prices instead of like, well, this looks cheap at $80 silver or $100 silver. It's like everything is going to look cheap at those prices. And if something has value, even if metals prices are 35 silver, 37 silver, or 3,000 gold, if something has value, that's going to correct much less. So, and I also look at the chart because if something has a rhino horn and it's gone straight up in the last 3 or 4 months and it's up 400% in the last year, it's just highly unlikely that that move is going to continue. And a lot of the good things are already discounted. I mean, remember, markets are a discounting mechanism. They look forward. So markets, these moves are based on the moves we've already had. They're based on what's going to happen in the next 3 or 6 months. So I don't care about that stuff for companies. That's already discounted. Like now it's an issue of, what's going to happen in 2026 and 2027. And yeah, so it's every company is different. And of course, again, there's different criteria for explorers, developers, and producers. And you have to be careful because a lot of these companies, they could come into a situation where they could just have the next 12 months where they're not going to add any value. And it's not their fault, but that's just where they are in the business. And so, something like that has made a rhino horn is up 400%, that thing can come back down 30 or 40% and, not make a new high for 12 or 18 months. I mean, this stuff happens in secular bull markets. So that's why people need to be careful. And again, they need to assess company by company and also compare companies against each other. Like if you don't know how to value these companies exactly, compare them against each other. Like that can help. So yeah, it's difficult because there's so many different companies that are at different stages, and then you apply or you evaluate producers, developers, and explorers all differently. But I will say with explorers, there's so many of them, and of course they're all over the place. But those are companies that I think the ones that have really good exploration results, they might have a chance to perform really well, even if the sector goes sideways for 6 or 9 months. So again, I mean, I'm repeating myself here, but it's a company by company situation.
Yeah, it's so true. And this is a market that is just grasping for news. Almost all news releases that I am seeing are being bought. So make sure that the companies that you're in have that sort of news outlook. Jordan, I'm curious though, and I know it's company by company, but if you had to balance out your portfolio weighted more heavily towards gold versus silver companies, To me, silver companies are much more of a shorter term trade. They can move way faster than gold companies, but I really think gold is, well, it's just a superior precious metal in terms of maybe a longer term investment, but you sometimes don't get that torque compared to silver. Where would you weight a little bit more of your portfolio? Would it be in more silver names or more gold names?
Generally, I'm more weighted towards gold names. I did wait, I don't know, 3 or 4 months ago, I did increase my positioning in silver and silver names. So yeah, I think at this point you should be at a high allocation of silver. And it does depend. I really hope with silver that silver doesn't have like a failed blow off here where it like goes to 60 or 65 and then that's a peak for like a year or two. I think that's one danger that we could get into with silver. But if we're just stepping aside, I think with silver, when it breaks 50, it's going to go to 100 12 to 18 months after it does that. So the upside in silver is so huge, and that you're probably going to see money come into the silver stocks even before that happens. So, my worry that it kind of has a failed blow off, that aside, I do think you need to be more in silver at this point compared to other points just because of what lies ahead. And, my guess is we're looking at this intermediate term correction that's going to start pretty soon. It'll go into next year. After that, you really could have a spectacular move in this sector. That'll be led by silver, of course, breaking above 50, and making that move to 100. So it's fine to trim for silver right now and silver stocks. And I think your comments are exactly right. I mean, it's way more volatile. They're generally riskier. And just the quality of companies, they're so much better in gold juniors. I mean, silver juniors, like they're such low quality after a handful of companies. I mean, these projects are not that great. And so you have to be really careful about what you own. Again, it's on a company by company basis. So I think people should focus on that less so than, oh, I need to, I need to buy more silver stocks. What's a silver stock? If that's your thinking, I would rather buy a gold stock I'm really confident in than like just a random silver stock because I'm looking to increase my positioning, if that makes sense.
Yeah, I think that's a great point. There's a lot of garbage silver stocks. I mean, there's a lot of garbage gold stocks too. There's just a lot more of them, but there's more quality and there's more quality management teams in the gold space than there is in the silver space. But there are a few shining examples. If you want to know those, you got to subscribe to the Daily Gold to find out how Jordan values the silver stocks and gold stocks. But let me just throw one more at you. The different stages of companies. We've talked a lot about producers, developers, explorers in your portfolio without giving away the secret sauce. Are you more weighted towards the producers, developers, or explorers at this point? What are the ratios that you would have in your portfolio?
I haven't looked at that. As you're asking the question, I just pulled up my portfolio and I'm looking here. I do have a couple explorers, and then it's a mix between producers and developers. So I know that's not a definitive answer one way or another. Again, it really comes back to look at the company first. I will say what's interesting is I did talk to Rick Rule. I can't remember the last time I interviewed him, maybe 3 or 4 months ago. And he did say like the big junior gold stocks that had huge resources in the ground, like those are the cheapest. And he was exactly right. Like those stocks have made a huge move recently. I'm thinking of like Banyan Gold or like Revival Gold, like those types of companies. Like he was exactly right about that. So that was one area 3 or 4 months ago where there was really good value. Again, it's like you look at things on a company by company basis. I think the last few opportunities that I found in the last month or two, those are basically developers. One was an earlier stage, one was a somewhat later stage developer. Because remember, you get the biggest bang for your buck by building mines and growing production. So I think if you can find developers that have a good project that's likely to be a mine and the market hasn't caught on yet, you can find some real value there. But what my fear is, and I'm not trying to talk in circles here, but what my fear is that the developers now, the ones that'll make the next move, are kind of the projects that are really questionable. Like they look good on paper, but they've failed in the past. So you do have to be careful about those situations. Versus, remember, the stocks that have already gone up a lot, some of those at this point, on a risk adjusted basis, they may still be a better value risk reward than a lot of these stocks that have not moved And you think, I mean, at this point, like a lot of those stocks are really cheap for a reason, for good reason. So you need to be careful about chasing stocks that haven't moved. Just put those aside and then just look at everything and try to find the best value. Even if a stock has moved 100 or 200%, it still may be a really good value. And then you make a note of it, and then maybe in 3 or 6 or 8 months, you see, oh, this thing's down 20 or 30%. Finally, I'm going to buy it.
Man, that's such a great point to wrap it up on, Jordan, just because a lot of people assume that if a stock hasn't run yet, that maybe there's some hidden value there. But a lot of times there are some warts and hair on that project, and that's exactly why that stock hasn't moved, or maybe they just don't have any news flow yet and haven't had news flow in a while. But some of the best stocks have also moved the most. So some of the companies that have quality projects that could become a mine, or they're quality producers and miners that have done well, the reason they've moved the most is because they are the highest torque stock. So got to keep that in context even during pullbacks. It may be an opportunity if we have an intermediate term corrective move to buy quality while it goes on sale. So some great points from Jordan here today. And for those of you that want to follow along with Jordan's work, definitely click on the link below in the show notes. It takes you over to the Daily Gold where you can follow along at least with Jordan's free service, but definitely check out the paid service where he gets into the stocks that meet his criteria and the rationale for why he buys, holds, or trims those stocks. And also take a look at Jordan's book, The Greatest Bull Market Has Begun. So, Jordan, always appreciate having you on the call and looking forward, as always, to our next conversation.